This voice is taken from an article with the title, How Do I Identify and Trade with the Falling Wedge Pattern, which has been published on TRADERTALKSNET. The falling wedge pattern is a chart pattern used by traders to identify potential reversal opportunities in the market. It is a bullish chart pattern, meaning that it indicates a potential upward price movement. This pattern is formed when T price action of a security is characterized by a series of lower highs and lower lows. To identify a falling wedge pattern, look for a series of lower highs and lower lows that form a wedge shape. The wedge shape should be sloping downwards and should be visible on the chart. It is important to note that the pattern should form over at least several weeks, with the most reliable signals forming over a few months. Once the falling wedge pattern has been identified, traders should wait for the breakout. The breakout occurs when the price of the security breaks above the upper trendline of T wedge, signaling an uptrend. Once the breakout occurs, traders can enter a long position, entering at the breakout point and setting a stop loss just below the lower trendline of the wedge. In order to maximize profits, traders should also set a profit target. This can be done by measuring the height of the wedge and using that as the profit target. The height of the wedge is equal to the difference between the highest high of the wedge and the lowest low of the wedge. This is the approximate amount of pips that traders can expect to gain from the trade. The falling wedge pattern is a powerful tool for traders, offering the potential for profits when used correctly. It is important to remember that chart patterns are not always reliable, so traders should only enter trades with the falling wedge pattern when the breakout is confirmed with strong momentum. Additionally, traders should always use risk management strategies such as stop-loss orders to protect their capital.